Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we'll be looking at the definition of redeemable preferred stock, also known as callable preferred stock. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at an example and give you a little more insight. Redeemable preferred stock is a type of preferred equity or stock which carries with it the provision that the company has the right to call or buy back in the preferred stock at a certain price and retire it. Let's go look at an example. For this example, we'll be looking at the balance sheet of Walmart Stores Incorporated. Scrolling down to the third section of the balance sheet, at the bottom section, you'll find the item stockholders' equity. We've got the tools here. Alright, under stockholders' equity, you have it broken down into various different positions within the stockholders' equity, and each one of these will typically have different rights with it. So when we're looking at redeemable preferred stock or callable preferred stock, this is preferred stock which the company can, at a particular point in time, actually force the holder to sell back to the company. You'll notice in this particular case, looking at Walmart, they don't have any of that. They haven't issued any of that. And this is actually something that you won't see a lot of because people don't like to go out and invest in something that later down the road, if it's a good investment, someone just comes along and says, "Oh, give it back to us." So they won't often see that, but it can happen from time to time. To understand preferred stock compared to common stock, you have to understand that preferred stock is preferred above common. What that basically means is that whenever you have, let's say, for example, the company were to pay a dividend. The dividend would have to first go to preferred stockholders, and then what was left would then be paid out to common stockholders. So that's one way it's preferred. And there's also typically preferred stock will have a higher interest or dividend payment than common stockholders will have. You can also get, with preferred stock, you're getting kind of a hybrid. It's kind of between a bond and common stock in the sense that you will get some activity to the upside as common stock does, but not as equal with it, so you won't have as much volatility there. Again, preferred stock can be put out in many different ways. It can be, in this case we're talking about redeemable, but redeemable preferred stock could also be redeemable preferred stock that has cumulative rights on the dividends. So let's say that Walmart were paying a dividend, and then for a couple of years they say, you know what, we really can't afford to pay a dividend, we're not going to pay it. Well, in that time period, common stockholders would get nothing. But if this were a preferred stock that was cumulative, it would actually have a debt to be paid later on preferred stock when the company started paying dividends again. So let's say a couple of years pass, and they say, okay, we're going to start paying dividends. Well, before common stockholders could get anything, the past dividends that are still owed to the preferred stockholder would have to be paid off, and then the preferred stock current dividend would be paid, and then anything left over could be falling to the common stockholders. So that's something else to think about. Typically, whenever you get these added benefits for preferred stockholders, you give up something, and in most cases that is the right to vote. So now you know. It should be noted whenever you're looking at a balance sheet that actually has a number out here under the redeemable preferred stock, what you're seeing there is what the company actually records after selling the preferred stock, but it's based on its par value or the stated par value of the shares. So let's say that I have some preferred stock for sale, Walmart does, and they turn around and they say, okay, the par value, this is $10 per share. Well, if they have somebody turns around and they buys, 1 million shares, then they would record right here at 10 million because it's based on the par value. So it would be par value times the number of units, and this would give you the actual number here. The reality of the situation is oftentimes common stock and preferred stock will sell for far more than the par value. So what actually happens is that amount that's different there, the company brought in the par value amount, but they also brought in an amount above par value that would of course go into capital surplus, so we'll get to that later. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.